Good morning, ladies and gentlemen. My name is David Lyle. I'm the Managing Director of the Millbrook Group. Thank you for coming along today. What the agenda is I'm going to have a chat to you about the last year that we've had and the outlook. Then Andrew Slattery is going to talk about the private credit market and the performance of our funds. And then we've got Stephen from WBP Valuers who's going to talk to you about the property market in Melbourne and Sydney in Australia. Just looking at the year in review for Millbrook, at the end of the year we got to a position of having 406 million of funds under management, and since 2017 when we took ownership of the business we've done 516 transactions. At the end of our financial year we had 2,452 investors on board now, and we've repaid to investors just over $800 million. The amount of lending that we've done is around 1.1 billion over that period. Looking at the year in review, the fund growth was 10.8, which is reasonably subdued, but the environment's certainly been quite difficult in the last 12 months. The diversified fund, which is a pooled option in the Millbrook Credit Fund, which we established a couple of years ago, that's grown substantially at about 32% for the year. That's another opportunity for investors. Some investors like select deals, specific deals. Some people like to go into a pool. The benefit of the pool is that you're obviously earning money every single day of the year, whereas sometimes with select your money will be sitting idle while you're waiting for another transaction to come along. So that is quite a focus of Millbrook over the last 12 months, looking to grow that. We've had a strategy of going out to financial planners and looking to get ratings, getting on platforms so that we can grow that part of the book, and that's what we want to do over time. We've recently just had an upgrade on a rating from a ratings house, SQM. Previously, Millbrook was rated at 3.75 stars, and we've been increased to 4. So, I mean, that's just a reflection of the work we've been doing. They've wanted us to have an independent board of directors, which we've done, and have a bit more transparency about our loan book and all, etc. Also, the Millbrook Income Fund, the wholesale vehicle, we've certainly, strategically, we've pivoted a bit away from second mortgages. They are a smaller part of our loan book compared with where we were, say, 12 months ago. No investor with Millbrook has lost money on a second mortgage, but there's certainly plenty of evidence that it's certainly a more dangerous area, and there is evidence in the market of people losing money on second mortgages. So we're still going to do them, but we're taking a lot more cautious approach, and we'll just do less of them, and we want to deal with people that we see as being very strong and generally having quite low LVRs is what we're doing. So still doing them, but just we prefer to do the first mortgages that are offered to us. Also, something we've done, which we're putting on our website quarterly, is detail of our portfolio and what our loan book is made up of. So ASIC's done a review into private credit, and one of the things that they felt was that there's not enough transparency on where the investors' money's going. So if you go into our website at the moment, you can have a look and see in the diversified fund how many of our mortgages we've got are between 0 and 40% LVR, how many are from 40 to 50, 50 to 60. So you can sort of see where where your money is being invested. So we're going to update that every quarter. Not many funds do it. La Trobe do it, Metrics do it, but generally people don't seem to want to disclose where the money is. So that's something that we've done. We've just done it, and we see that as being an improvement. Also at Millbrook, the shareholders and management continue to invest. At the end of March, the investment from that group was just on $19 million. So one of the things that we often say is that, would we put our own money into this transaction? and in most transactions we are putting our own money in. We've got investments in the enhanced, the wholesale pooled option and the diversified option, and then obviously select deals. So we'll continue to do that as we move forward. And during the year we've expanded the team somewhat. We want to do more origination in New South Wales and Sydney. Our loan book is skewed towards Melbourne and Victoria. So the rating agencies are saying we need to get more business in different areas of Australia. We've taken on a chap, Peter Thomas, ex the ANZ Bank, and he started 2 or 3 months ago, and we're starting to see some transactions coming from him. Also increasing the investment team, we've taken on Reagan Williams in Queensland, and we also have a replacement, Paul Banda, who's come in from La Trobe, who's just become a member of our investment team as well. And we've improved marketing, and we've also employed someone in asset recovery. So if we've got loans where we've got issues, we've got someone dedicated to that area. So they're the improvements we've made. Just looking at the outlook, say for the next 12 months, what I would say is it's very competitive out there at the moment. Everyone has a lot of money. Lots of people are continuing to establish private credit funds, wholesale. Generally, they're wholesale funds, but everyone sees it as an area that they want to get into. So when we see a good transaction, there'll often be pricing at a certain level from, say, 2 or 3 suppliers, and then one person will come in at half or 1% less than everyone else because they really want that transaction. So, we at Millbrook, we try to do about $30 million of business a month, and last year pretty much got there, but last month we only did 25. So it's just a real grind. It's just, and also there's not as much business activity being done, so there's not as many developments, higher interest rates, etc. People have just slowed down, higher construction costs. So, but I think with these round of interest rate cuts we've had, the 2 cuts we've had, plus more coming, I think people will start getting more positive, and we hopefully, as the year progresses, we should see more transactions. And I had one of the investors here today saying to me, look, I haven't been seeing many transactions, and that's just because we have been a bit quieter than we would like to be, but it's just quite a tough market at the moment. Yes, as I said, New South Wales, we want to do more business there, and I think in the course of the year we'll certainly have more transactions coming from there. What is pleasing is that property values are on the rise. I think for the last quarter in Victoria and New South Wales, there was a 1% increase in residential property values. A couple of nights ago on the ABC, Alan Kohler showed a graph of over about a 20-year period where there'd been a continuous decrease in interest rates, what had happened to residential properties. And on average, over the next 2 years, there'd been a 20% increase. Some were 50, some were 30, some were 10, but on average, there was a 20% increase. So I think we're going into an environment where the values are going to increase, and as a mortgage lender on these properties, that's good for us. Also, housing demand supports our sector. The Labor government's obviously keen to build more houses. They've got a 5% deposit scheme for first home buyers. That's going to help. So everyone's talking about more building, more housing, so that should stimulate demand. Obviously, interest rates to investors, we see them just dropping slightly. Just as the rates go down with the Reserve Bank, our rates will just go down as well. But I think all private credit funds and banks, etc., will all be doing the same there. As I said, government housing initiatives will boost our sector. I think there'll be more houses being built, and that's what they want, which will be good. And really, what the products that we're offering, we don't see them being related or correlated with other asset classes like Australian shares, etc. What we're offering is just a consistent monthly return secured by first mortgages on properties in Australia. And from Millbrook's perspective, we want to keep growing. It's been tough lately to grow because we just haven't had the business. But we can see over the next 12 months or between now and the end of the year that things will get a bit better, and we should have a few more transactions coming through. Our focus will be on first mortgages and some, the odd second from time to time. But that's what we'll be looking to do. So now I'll hand over to Andrew Slattery.
I'm going to kick off my part of the presentation and give you some insights into the property credit sector as we see it at Millbrook today. So as David mentioned, we're certainly of the view that rates and returns have peaked in the sector, and our expectation is definitely that investor returns are going to come back a little bit in 2025. However, we still think you're going to get good risk-adjusted returns on your investments, particularly when compared to other fixed income investments such as government bonds, corporate bonds, and obviously term deposits. David mentioned it had been tough in 2024 and across the sector. Quality loan inquiry has definitely slowed on the back of increased demand and also property investors and developers sitting on their hands. But with the rate outlook now a little bit more positive, we're hopeful that sentiment will pick up in the sector, and we expect demand to pick up as the year goes on. In terms of the non-bank private lending space as a whole, it continues to gain market share year on year. And there's a number of reasons for that. One of them is speed. So banks are still incredibly slow to act. They can be anywhere from 3, 4, 5 or 6 months for approval if it's remotely complex. Whereas a place like Millbrook, we can settle a loan within 2 weeks. So speed is critical, and that is certainly continuing to drive growth in this sector. Banks continue to avoid certain asset types and security types, and when they do lend against say vacant land or things like that, they apply much more onerous conditions than they used to. So that lack of flexibility is a real problem for borrowers, and at Millbrook we can certainly tailor the lending solutions to meet the borrower's requirements. And ultimately, banks are heavily regulated by APRA. So in my opinion and many others' opinion, there has been a structural shift that's gone on in the Australian lending environment, which has seen banks permanently retreat from certain lending areas, and that void's been permanently filled by places like Millbrook. And the next couple of slides hopefully just help you visualise what has gone on in this market. So this slide just depicts the overall private credit market in Australia and shows the growth from 2015 through to last year. So in 2015 there was about 40 billion market share in the private credit space, and by 2024 that was over 200 billion and sitting at around 205 billion. So obviously really strong growth over that time period. And from 2015, that is when the banks really had to start to implement the new Basel III capital requirements, which meant that they had to apply more capital to certain loans, and that led them to pull back from certain lending sectors. And that's why you saw a really big jump from 2015 onwards in the non-bank market share. This slide specifically looks at commercial real estate debt funds, and this is the space Millbrook plays in. So basically it's just commercial loans that are secured by property. And you can see here again, exponential growth from 2020 onwards in non-bank commercial real estate market share. 2020 was around 7% of the market that non-banks had, and by the first half of last year it had jumped to nearly 16-17%. Again, a number of factors that have caused this, and I've touched on a couple of those already. But this right-hand side image, I think, just helps illustrate how much more onerous it has become for borrowers to deal with banks when it comes to commercial loans. And it looks at the typical covenants that banks apply to commercial loans. I certainly don't want to bore you with a deep dive into bank covenants, but I think it does help illustrate a couple of key points. So pre-GFC, typically banks would offer an LVR of around 75, maximum LVR of around 75% on commercial loans. And if it was a development project, typically the bank would require some pre-sales of between 50 and 80%. Between 2009 and 2015, the maximum LVR had come back a bit to 65%, and pre-sales between 80 and 100%. And then post-2015, a typical maximum LVR on a commercial loan was down to 55%, and pre-sales often the bank would need 100%. So if you're a developer, 100% pre-sales before you've done anything, that really can impact your profit margins. and an LVR of 55% is quite low, and obviously would force the investors or developers to find other capital sources. So you can see it's become much more onerous for borrowers, and that has led them to the non-bank sector, who provide much more flexible terms. But Australia's actually a bit of a laggard compared to some of our global counterparts in this space. So if you think about the US in commercial real estate lending, it's about an even split between banks and non-banks. And in the UK, the non-banks have about a 25% market share in this space. So I don't think we'll ever get to the 50-50 mark here in Australia, but I certainly think there's still plenty of room for growth, which is good for obviously places like Millbrook. This next slide is a lending comparison just between property credit and direct corporate lending. And the reason I've put this slide up is that there's been a lot of noise about private credit in recent times, particularly in the AFR and other financial media. But private credit is a very broad term. It's a very broad universe, and no one loan is the same in the private credit world. But often if you're reading this press, they'll often suggest that all these loans are the same, but they're certainly not. So I thought I'd just delineate between property credit and direct corporate lending, probably the two biggest subsectors of private credit, just so you can get an idea where they do differ. So with property credit, which is obviously what we do at Millbrook, typical loan purpose is usually some sort of property-related funding. Borrower types tend to be developers or property investors, and the security behind these property credit loans is always some sort of mortgage, and more often than not, a first registered mortgage. With direct corporate lending, the loan purpose will vary, but it's typically to fund business operations or working capital requirements. The borrowers tend to be SMEs or business owners. And when it comes to security, there'll always be a general security agreement over the company assets, so effectively security over the cash flows of the business, but more often than not, it's not backed by physical security. So there's a big difference between the two. There's certainly nothing wrong with direct corporate lending, but you just might want to understand, it is a different risk profile to what we're doing here at Millbrook. And to just reiterate that point around the security that you get with property credit, this is just your typical capital stack of an investment, and many of you would have seen something similar in the past. So at the top, senior debt or first mortgage sits at the top. Then you've got subordinated debt or second mortgages, then preferred equity, and then common equity. So senior debt has the highest priority and therefore the lowest risk. And you go down to common equity, lowest priority and therefore highest risk. So Millbrook, the Millbrook Credit Fund only invests in first mortgages, and the Millbrook Income Fund predominantly invests in first mortgages, but also does invest in some second mortgages. So the key here is, when you've got that first mortgage, you're at the top of the capital stack. If something does go wrong, we're first in line to recoup the capital, which is obviously critically important. Now we're going to pivot slightly and just talk through some of the key lending principles that our credit team focus on. And we're lucky enough today to have our head of credit, Colin Robinson, and our head of origination, George Lyle. So if you've certainly got some questions after the session, feel free to hit them up. But I don't want to bore you with a deep dive into our credit analysis, but I think it's just important just to highlight a couple of the key things that the team do focus on. So sponsor assessment, obviously very important. Does the borrower have look at their character and their track record? Do they have the relevant experience for whatever they're proposing to do? Alignment of net worth to debt is an important one. So if someone's looking to borrow, say, $5-10 million and they're only their net asset position's a couple $100,000, there's a misalignment there, and that would be a red flag for the team. And we want to see some sort of meaningful equity contribution so that the borrower's got some skin in the game. We don't want them, typically to be borrowing 100% of whatever they're proposing to do. Loan purpose and repayment obviously very important, so we want to understand what the funds are for and does it make sense. The number of loans that come across the team's desk, where it doesn't make sense, is begs belief, but certainly that is a key thing that the team look at in the first instance. Want to understand that the borrower's got a defined repayment strategy, and if the timelines that are in place are realistic. And we want to make sure that the borrower obviously understands what these critical milestones and steps required to get there are. When it comes to development funding, builder risk is a big one at the moment. It always has been, but probably even more important at the moment. So not only will the team look at borrowers' financials, but they'll also look at builders' financials to make sure that they're financially sound and also reputable. When it comes to the project itself, they want to understand that it has been fully considered. and evidence of market acceptance is always good because that if they've got some pre-sales, well then it means they're building a product that people want. And when it comes to land for development or subdivision, we want to make sure that obviously that is feasible and viable as well. And finally, the exit, obviously critically important, particularly with our shorter loan duration or the shorter loan durations that we do, typically around only 12 months. So we want to make sure that there is a defined exit plan and it's achievable. If it's a pretty wishy-washy exit, then the team's probably going to pass on that transaction. And following on, just from those key principles, I thought I'd touch on I'll show you a couple of recent case studies of a loan we did proceed with and one that the team knocked back. So the one on the left is a loan that we did proceed with in Mermaid Beach, Queensland. First mortgage backed by a residential asset. LVR here was 65%, loan amount was just over 4 mil, and the loan term was 12 months. So the reason, or a number of reasons the loan, we elected to approve that loan, but the borrower was pretty strong. They had a declared net asset position of circa 20 million. They had strong income that was able to be verified by the team. And there were multiple exit sources. So this loan was a bit of a quasi-bridging loan in that they were leveraging this particular asset to go into another investment, but they had to put a number of other assets on the market for sale to clear this debt. So we were pretty comfortable approving that transaction, and that went out to direct investors and also sits in our diversified fund. Now, the one on the right is a loan the team did not proceed with. This one was in Berwick here in Melbourne. Again, a first mortgage backed by a residential asset. The proposed LVR was 50%. Loan amount was 2.5 million, and again, the term was 12 months. So on face value, that looks like a pretty reasonable transaction. Got a residential asset in a well-established outer suburb of Melbourne and a pretty conservative loan-to-value ratio. But the team didn't proceed with this one, really around the exit being compromised. So there were some environmental issues with the site. I think there were some heritage overlays as well. And when the team contacted some local agents, it was quickly realised that this was going to be a relatively illiquid asset. And if we did have to sell the asset, the likely sale period was at least 12 to 18 months. So from an investor point of view, if we're thinking about worst case scenario, that's to recoup capital, 18 months is just way too long. So the team declined. That was the main reason why the team declined that transaction. Moving on to our investment options. So I'm going to start with the Millbrook Credit Fund. So this is, as many of you know, is our retail offering issued under a product disclosure statement, and it only invests in first mortgages. Two ways to invest. You can go into our select loans, which is where you get to pick and choose which loan you want to invest in based on your own risk preferences, or you can go into our diversified option, which is our pooled first mortgage fund. With the select, at the moment, the returns are between sort of 8 and 9%, obviously depending on the type of loan. If you think down there towards 8%, it's going to be a conservative loan-to-value ratio backed probably by a residential asset. And up towards the 9% mark, you're probably looking at maybe a construction project. The term obviously is going to be based on the individual loan that you're investing in. When it comes to the diversified fund, at the moment we're returning 7.25% per annum, which is paid monthly. The minimum term is 12 months in this fund. And I'll touch on a little bit more detail on the next slide on the makeup of this portfolio and some of the key guidelines that we adhere to when managing that fund. So for this fund, we'd certainly have a preference for residential security as the backing or as the security for the loans. The main reasons are there is that residential values are better understood. We've got more confidence in those, and there's a lot of demand for assets across the metro cities of Australia for these types of assets. We put a limit on construction and vacant land in this portfolio, so at 20% respectively. There's a maximum allowable of 5% any one borrower or any one loan in the fund. And we're targeting a weighted average LVR of 50 to 60% in the portfolio. And at the moment, we're hovering around 55%, so pretty good capital buffer there for investors. And at the moment, there's about 72 different loans in the portfolio, so pretty well diversified by loans as well. In terms of the portfolio mix, you can see there the security type has got that skew to residential property, and then we've got a nice mix of vacant land, commercial, construction, industrial and cash. And then security location, David's mentioned before, obviously we're a Melbourne-based fund manager and we've got an overweight to Melbourne and Victoria, but we'd certainly like to certainly increase our New South Wales and South East Queensland loan book. And obviously we've got that presence now in New South Wales to help with that. But we won't just geographically diversify the book just for the sake of it. Every loan's still got to meet the criteria based on our lending policy. To the income fund, so this is our wholesale offering, so only available to wholesale investors. And the big difference with the income fund is it invests in first and second mortgages. Again, two ways to invest. You can go into select loans where you get to pick and choose the loan that suits your risk preferences. And at the moment, on a first mortgage basis, you're probably looking at high 8s to high 9s in the income fund. And if you're looking at second mortgages, when we do those, you're probably looking at around 14 or 15% return there, but obviously with a very different risk profile. Then we have the Millbrook Income Fund Enhanced. That is our wholesale pooled option. And the last quarter's return was 9.72% per annum on an annualised basis, and that is also paid monthly. In terms of the enhanced and the portfolio profile, the full year return, so from April last year through to March this year, was 9.75% per annum. The weighted average LVR cannot exceed 70% in this fund, and it's currently at 63%. Maximum of 30% is allowed in second mortgages, but at the moment we're only at around 16%, and we'd probably like to keep it under 20% going forward. And it's spread across 38 different loans at the moment, so pretty well diversified, and no loan greater than 5% of the portfolio, and the fund can have no borrowings. When it comes to the portfolio mix, pretty happy with the security type mix. As you can see there, it's spread quite evenly across all those various sectors. And again, with the security location, certainly an overweight to Melbourne, but again, we're looking to do more in New South Wales and Brisbane there. Now, last couple of slides I'm going to touch on is around our performance comparison, and this slide here just compares the average return that you would have got across our select investments for the last 12 months and compared that to the average term deposit rate and government bond rate. So at the top there, the average return for our income fund's second mortgages over the last 12 months was 14.63% per annum. Our first mortgages in the income fund had an average return of 9.84% across the last 12 months. And in our credit fund on the select transactions, the average return for the last 12 months was 8.76% per annum. So you compare that to the average TD rate of 4.5% and the government bond rate of 4.31%. It's a pretty good premium that you're getting, and we're pretty happy with that performance, and certainly think that you're getting rewarded for that, that risk that you are taking on. And the last slide is another performance comparison. This slide is comparing the Millbrook Credit Fund Diversified average return over the last 4 or 5 years and compared that against other asset classes like the ASX 200, MSCI Australia Index, the 10-year government bond and the cash rate. So the Millbrook Credit Fund Diversified return is depicted there by that orange line, and as you can see, it's a pretty nice, smooth, stable return over that time period with very little volatility, particularly when compared to the Australian share market. And that's exactly what this investment's designed to do: provide you with stable monthly returns, and it's largely uncorrelated to the asset classes. So we're pretty happy with the performance we've been able to achieve over that time period, and certainly continue to strive to deliver on that for our investors. That's all from me. There'll be definitely time for some questions at the end, but now I'm going to hand over to Stephen from WBP to give us his update on the property market.
Thanks, everyone. So I'm here to talk about I'm actually talking about Metro Melbourne property market. So about WBP, we are one of the 4 biggest valuation firms in Australia. We're independently owned. With valuations, we're all sworn valuers. So every single one of our valuers has got a Bachelor of Property. We're all risk experts. So when we talk about risk with you guys on properties, we also do the same thing. All our valuation reports talk about environmental issue, heritage issues, all that sort of stuff. So I just wanted to probably start by saying we're not real estate agents, we're sworn valuers. We have offices around all of Australia, and we employ about 200 staff nationally. I'll go through Metro, Northern, Western, Eastern, Southern, and some apartment stuff. The last 12 months in Victoria has been pretty stagnant. Clearance rates are sort of at that low 60%. The volume, especially this year, has not been there. We're looking at, like last weekend, there was only 700 or 800 auctions, which is pretty low compared to your usual 1,000, 1,100, 1,200 that you would usually see on a normal weekend. There's very limited supply hitting the market. Agents are selling stuff off market or prior to auction. We've seen a lot of investors get out of the market, so a lot of like mum and dad investors, let's say, get out of residential property. Land tax issues, higher borrowing costs. A lot of people have been selling some investment grade property and spending their money on a nicer, bigger owner-occupied property. So that's what we're sort of seeing in the market. There's a lot more educated buyers out there. A lot of building and pest and finance clauses are being used. So it's a market where people are acting a lot more cautious than what they have in peak markets where they're just rushing to go buy anything. There's a little bit more, everyone's a little bit more like acting cautiously. I was actually working in the Mornington Peninsula during 21, 22 when there was that big peak during COVID. That market has really changed. I've got a slide up at the end which sort of shows like Rye, which is one of the suburbs down in the peninsula. I've been watching this one a lot. There's 153 houses for sale in Rye at the moment. It probably peaked at 200 at the end of last year. So there's a lot of supply in the peninsula. All that holiday house taxing, all that Airbnb stuff is really hitting those people. It's probably come back 20% in the peninsula from that real peak. I think the real positive the last few years has been that a lot of first home buyers have gotten into the market, which has really been Labor's sort of strong point is they want to make it a lot more easier for them to enter the market, 5% deposits. It's good to get those people in. That segment under $1 million for units, townhouses is doing really, really well. Rents have stabilised. Probably our biggest concern as valuers that we're seeing there's a large gap between units, apartments, townhouses and dwellings. So that gap to buy a house compared to a unit is growing and growing and growing. And that sort of worries us in saying, what's the next generation going to be able to buy for a home in the inner areas or 20 kilometres from the CBD? I've put some case studies up from my director. So we've got a northern director. So he's given me some examples. Good family homes are selling really, really, really well. So for example, we've got an inner northern area and a middle band location. New houses are really strong because it's costing a lot more to do and people have limited faith in, not limited faith, that there's a lot of effort involved to building those properties in this market. So those are some two studies that we've got here, really strong results. My Western valuer nearly fell off his chair when he sent me this one. This is $7 million in Maribyrnong. So beautiful home. $7 million is a lot of money. So he just pointed this one to me, and if you want to jot down that address, beautiful house to go have a look at it. Eastern Metro. So this is actually one of my valuers, that Surrey Hills property. He's an owner developer. He actually built this property. Did a really good job out of it. So I think it was 2.7 for the land and he sold for nearly 5.6. So there was some really good profit in that project. I guess with valuers and I guess with educated people, you can make a lot of money in this market if you're producing the right properties. And then Southeastern and Metro, I am so confused by this Elwood St Kilda market. It's 3-4 k's from the CBD. It should be doing really well, but the apartment markets has just not moved. So like an example there on Shelley Street, which is a really good spot close to Glen Huntley Road Shops there. Sold in 2019 for $765 and after 6 years it got $735. So that's an Art Deco apartment in a premium location. There's that Peninsula slide that I wanted to show you all. There's 153. Rye is a big suburb, granted, but there is a lot more stock in the Peninsula coming on. And then what I've written there, Middle Band, Beaumaris, Blackrock, Cheltenham, Mentone, Parkdale, Morty Alex, Strong up until that 1.8 figure. Buyers above this range in that middle band area a little bit more picky. Villas, houses, townhouses under 800 from Cheltenham through to Frankston, Carrum Downs really strong with first home buyers. We've noticed probably some developers get out of the market. So this was a developer example in Parkdale. It was on Beach Road. 2022 sold for 3.3, got out in Feb for 2.905. So it's a bit on that one. And then I just thought I'd chuck in some stuff about apartments. Like, good apartments are doing really well. Stuff that are low density, with some views, bigger size, natural light. There are your strong drivers for those products. I guess as well, reputation, developer, builder. We've seen some pretty shoddy apartment work recently, like builders are producing some pretty ordinary work. So I guess for us, it's looking at the reputation of the builder and making sure that they build a good quality product. And yeah, so looking at off the plan apartments versus resale apartments, a lot of people, there is that tax incentive. So I guess that is a big driver for some people investing in off the plan apartments. But there's just not, like, developers have to try and sell products for $12,000, $13,000, $14,000 a square metre at the moment to try and recoup that construction cost. And there's just not that value in these securities at this point. So I think that's why we're saying that apartment supply and developer activity has sort of weakened the last couple of years because of those costs with trades and materials. Just to conclude, we have had our second rate cut now, which is great. I hope that helps, and I think it will in Melbourne. Every other market in the country is doing really well except for Melbourne, so I think that gives us faith that we are probably due for some growth. I hope it's between 5 and 10% in the next 12 to 18 months. First home buyers have been incentivised to enter the market, which is good. We've seen cash poor landlords exiting out of the market with new taxes and minimum standards on rental properties. The market is still patchy, even as values. It's hard to pick what will do well. I sold a house, the property that I'm living in, actually, we sold our family home a couple of months ago, and it wasn't easy. Like, the buyer depth wasn't there. It was hard. I guess that's what we're seeing in the market. Construction has slowed. Prestige market's still okay. There are still buyers in that 5+ market. And as I said, there's a lot more educated buyers in the market with finance clauses and building and pest. I'm sorry my advice can't be obviously giving you advice on where to invest your money. I'm sort of limited with what I can say, but the examples that I've given you are case studies that we've worked on or what we've seen. And yeah, I'm sorry if this has been pretty general, but yeah, this is just our general take of what the market in Melbourne is doing. Great, thank you.